I've been investing in real estate across the country for the last decade. I've purchased over $190 million in real estate. And one of my friends said, "Why are you not raising capital?"
But then all of a sudden you could talk on the internet about crowdfunded real estate deals for the first time in US history, or any history for that matter. And it created this massive boom of the business. Most people think in order to own a $50 million property, you got to have like a $20 million net worth. Not true. You can invest $50,000 and there's 100 of you and you buy a $20 million deal. So here's the thing about real estate. You shouldn't go and invest 20 grand with your random uncle. But what I like to do is find someone that stands to gain millions.
Look for people that have a highly motivated upside. But what are some of the other variables that you're looking for to help you feel like, okay, this is someone I should be giving my money to or should be having a conversation with?
Totally. So, I mean, first of all,
welcome to the Millionaire Hairstylist, where our mission is to improve the financial well-being of creative professionals. One of the topics we get asked about a lot is the subject of investing in real estate. So this week on the podcast, we're going to speak to two guests who are experts in a kind of real estate investing called syndication. I'll let you hear from them about what that means. Our guest today is Hunter Thompson. He's undoubtedly an expert in this topic, having raised over $85 million for investments in things like multifamily, mobile homes, self-storage, and he'll explain how investors can get involved in these kinds of investments. I think this episode and the one that will follow is really an exercise in expanding your understanding of what is possible with your money. And that's something we try to do in every episode here on The Millionaire Hairstylist. Now, keep in mind, neither myself, our guest, or Cash are financial advisors or lawyers, so please consult both when you're making any important decision with your money. Okay, let's get right into it. Here's Hunter Thompson on The Millionaire Hairstylist. Our guest today is Hunter Thompson. I mean, he's got some major stats here on the board, Cash, that I'll hit on quickly. And then I want to kind of get your side, Cash, on why Hunter is with us today and how you found him. But Hunter has raised over $85 million for investments in real estate, and that includes multifamily, self-storage, mobile homes, commercial real estate. He's also taken his company raising capital from $10 to $10 million in revenue in under 31 months. And he's the founder of one of the most well-known fundraising masterminds in the investor world. And Cash, you and I talked to the audience here at the Millionaire Hairstylists a lot about how creative professionals need to think outside of our industry when it comes to making wise decisions with our money. And I think that is the thought process that has sort of led us to having Hunter with us today. And Cash, maybe you want to just tee up how you're involved with Hunter and with raising capital.
Well, you guys know that I have businesses in multiple different industries. And what I've learned from being in multiple different industries is that there are more similarities and more lessons to be learned across disciplines that you can give you really unique insight into things that you can do in your business, your main business, that you wouldn't find when you have this sort of incestuous informational situation going on. There's like sort of like an in-industry echo chamber. And so I know that studying other industries and other practices and other disciplines and even things outside of business have impacted my ability to implement really, really effective systems, strategies, and ideas into my businesses. And so I've been investing in real estate across the country for the last decade. I've purchased over $190 million in real estate. I've done over 800 transactions. I've done a little bit in real estate. And one of my friends said, "Why are you not raising capital? Why are you doing this the slow and hard way?" And he said, "You've got to check out this guy, Hunter Thompson." I read Hunter's book, phenomenal book. I started studying what raising funds in real estate and real estate syndication looked like. And I became fascinated and started working down that path. And so my friend said, "Hey, I'm going to this event. Do you want to go?" I went. It was actually the most informational and effective masterminds I've ever been a part of. And I thought, you know what? Hunter's doing some incredible things that I think are really valuable for entrepreneurs, creative entrepreneurs, small business owners to understand. And when I saw what he was doing, I was so impressed. I had to get him on the podcast. And here he is today.
Hunter, thanks for being here. How are you?
I'm super excited and honored to be on and excited to talk to your audience in particular, Cash. So thanks again for the opportunity.
Let's just start. I think if you would, Hunter, just indulge us. Obviously, I put some of the sort of stats up there to begin with, but can you just give us an overview of your story and what has brought you to us here today?
Yeah. So basically after college, I graduated in 2010 in the heart of the Great Recession, in the heart of the real estate crisis. And around 2008, when this was going on, I was still in college and I kind of thought, okay, this is the quintessential blood is in the streets moment. I was just a college kid, so I wasn't wiped out. I was like, this is a great opportunity to go all in. But I definitely wanted to help my friends and family get money out of the stock market. And so we started investing in real estate very quickly and cycling out of the stock market. And then I kind of had my last straw moment, not in 2008, but actually in 2009, which is when the European debt crisis happened. And it was like, under what circumstance could I possibly been prepared for this? What book could I have read? There's no Warren Buffett, Charlie Munger book about the freaking Greece bond yields determining your entire family's net worth. And so I was like, this is a casino. There's no way I could have predicted or mitigated that risk. I've got to get into something simple that is recession resistant, that I can actually predict based on supply and demand, not casino finance mumbo jumbo nonsense. And so that put me on a long path, which ended in me, uncovering this world of passive syndications, which we're going to talk about today, which is essentially finding operators that are specialists in various asset classes, such as mobile home parks, self-storage, and non-real estate deals, by the way, where they're not just managing the property, they're managing the manager, they're going and underwriting the deal, they're talking to brokers, they're going on the loan, they're overseeing the entire investment thing, so that you as a passive investor can simply defer to their expertise and have exposure and diversification to their respective niche in their respective geographic location. Now, that is a term, syndication, that now maybe some of your listeners have heard of, but back in 2010,
most haven't. Can you just define the term? That would be helpful.
Essentially, it's crowdfunding for real estate.
Got it.
And the reason this has become more popular is that in 2010, it was literally illegal to talk about these deals on the internet. But in part because of the recession, there were moves made from a regulatory standpoint to open up the market to allow people to fund deals, because the government wanted there to be a stopgap of the nightmarish tailspin of foreclosures. Obama signed something called the Jobs Act, which then allowed something called 506C, not to get technical, but then all of a sudden you could talk on the internet about crowdfunded real estate deals for the first time in US history, or any history for that matter. Mm-hmm. And it created this massive boom of the business that I was like 3 years ahead of because of just my natural interests. And now we're here today, and I'll tell you all the stories and the ups and downs and all around, but structurally speaking, it's a very powerful vehicle, because most people think that in order to own a $50 million property, you got to have like a $20 million net worth and maybe you borrow some money. Not true. You can invest $50,000 and there's 100 of you and you buy a $20 million deal. And by the way, what's crazy about this is now, if you aren't familiar with this already, when you drive around, I don't know who I thought used to own all these multifamily apartments, but it's like something, it's like, oh, it's all like some bank, like Bank of America owns this like apartment in Texas. No, it's literally hundreds of pooled investors together, depending on an operator who's overseeing the whole thing. And up until 2012, it was basically larger institutions, but now it can be you if you're listening to this. And so I'm trying to help people get control of their financial future, get money out of the casino and into recession-resistant real estate.
Hey, if you're enjoying this podcast and you want to further your financial education, you can do so for free. Go to millionairehairstylistpodcast.com, where you have an entire library of free financial lessons aimed at the well-being of creative professionals, including a lesson on why budgeting is a terrible, soul-sucking way to manage your money and why allocation is a much wiser system for managing your resources. Go to millionairehairstylistpodcast.com and sign up today. Let's start here, because this is huge. Because Cash, you and I talk to people about buying growth assets, things that you can own and control that can grow in value and generate profit for you. We talk about, not just living your entire life earning an income and hoping that by saving your money, that's going to make you wealthy at the end of your career. And there's no topic, Hunter, that people want to know more about than real estate. But there's that feeling about real estate when you're talking about investing real estate, like, wow, how am I going to learn everything that I need to learn to be able to successfully do what Cash is doing, build a real estate company or sell more than one property? So the idea that you could participate with someone who is doing the sort of the legwork and doing that in a structured way that is not like, hey, my buddy says if you give him 20 grand, he'll give you some money back. Can you kind of walk us through, like, how do you find these kinds of people? What are, how would you even approach something like that if you're an investor who's looking to do something with your capital besides, like you say, just putting it straight in the stock market?
I'm really excited to have this conversation. One of the reasons I was excited to do this interview is that I've done so many interviews where people are so sick and tired of hearing about this stuff. It's so great to talk about
we're
it
like fresh.
and reveal it for the first time, because I couldn't believe this. Here's the thing about real estate. Everyone has an uncle that lost money in real estate, and they tell you, you know what, don't do it. Because I bought this property that was $20,000 and then I lost my shirt and I lost the 20 grand. You shouldn't do it. And here's the thing. You shouldn't do it. You shouldn't go and invest 20 grand with your random uncle. But what I like to do is find someone that stands to gain millions or tens of millions of dollars. And by the way, potentially lose tens of millions of dollars if things go wrong, and defer to their expertise. This is not the mom and pop game of real estate. This is everyone from Princeton Business School, MBAs, you name it. Those types of people are attracted to this space. But it's not so complicated that a small group or even an individual can actually understand it, right? That's the benefit of real estate. There's a lot of billionaires in real estate and there's a lot of geniuses in real estate, but you don't have to be a genius to be a billionaire in real estate. Obviously, I'm here talking to you right now. You know what I mean? So it's simple enough so that you can grasp it because it's based on supply and demand. But it's potentially lucrative enough so that you attract really high caliber talent. And so now what I'm talking about, not buying one $50,000 property where the manager will make $80 a month. Think about the level of talent that will attract. I will invest $50,000 along with 100 other investors. We will buy a $15 million property that we hope to turn into a $25 million property. I'll probably keep 70% of the proceeds, and me and the other investors will keep 70%, and someone's going to make $3 million. That's the kind of person I want to rely on. That's why I like dealing in the institutional, quasi-institutional, passive investment world, where we're not buying $50,000 and $100,000 properties, but $10 and $25 and $50 million properties.
Those numbers are always so overwhelming if you're just learning about these topics, because I used to think, oh my gosh, these numbers are gigantic, because you only think about them from like, how much money would I have to earn to have $50 million property? Or how much would I, but I love what you're saying. And this is so true with syndication, investing in high quality operators who have a lot to lose, who stand to lose a lot, who stand to gain a lot, and then partnering with a lot of other investors in a passive way where you're not changing toilets. You're making 70% of the returns. You're getting the benefits of depreciation and all the a myriad of tax benefits, or however the fund is structured. Talk a little bit more about, how would I spot one of these? How to avoid the bad ones, because I feel like still so like you mentioned something that's really important. Look for people that have a highly motivated upside, because it's going to attract the best people. So I love that as like a barrier. Like, is there enough in it that a smart person would be doing this? That's like a great place to start. But what are some of the other variables that you're looking for to help you feel like, okay, this is someone I should be giving my money to or should be having a conversation with?
Totally. So, first of all, going down this rabbit hole, if this is the first time you're hearing about this concept, what I would do is I would just start Googling around and listening to podcasts, and don't go and give someone 50 grand.
Right.
Because we're talking about illiquid, serious investments that are going to probably be tied up for 5 years or sometimes 3 or 7. So what I would do is go all in on education. Maybe you can go and listen to my show. It's free. It's the Cash Flow Connections Real Estate Podcast. But there's others out there. Find someone who you are aligned with from a core value or at least gut feel perspective, and just devour the free content that's out there on the internet so that you're kind of knowledgeable before you make any investment. And that's not just me making some disclosure. I truly mean that, because I want you, when you send that check, to know with confidence who you invested in, what you invested in, the expectation, and the sensitivity analysis of how it can go well or how it can go not so well. So that's the first thing I would do. But along that rabbit hole, what you'll uncover is it's actually a pretty tight-knit community. Even though it is a big world of real estate, there's probably like 50 people that I personally think are worth investing in, like in the country. You know what I mean? And you'll uncover them very quickly in terms of the way they present themselves, their background, their track record. An easy tip for being a passive investor is trying to limit this risk of lack of predictability of outcome and try to rely on what we call operators. These are the people that you would be relying on to invest passively. how much of their business plan is rinse and repeat versus new business initiative. I hope it works out. And we can start big picture and we can work granular. So let me give you an example. My company, ASIM Capital, we have a background doing a lot, but we recently totally retooled our model to only focus on Phoenix multifamily. So there's like a 40-mile radius. We only do Phoenix multifamily. We know the market. We know the sub-markets. We know the managers. We know the brokers. We know the lenders. You name it, we know it. And so when we bought 2 assets last quarter, we're about to buy our 3rd in the same sub-market with the same manager, with the same debt broker. And by the way, from the same seller, which is not typical, by the way. It's like, how likely is it going to be that we're going to be able to do the same thing we've already successfully done at the previous assets, right? And we just do it over and over again. But let's get a little bit more granular. Anyone in business knows when you have some new initiative, the risk is very difficult because it's subjectively determined. The reason I like commercial real estate is it's about the numbers. When you go into residential, the wife loves the pool. Man, how good is that view? You know, what's the number of that? It's hard to figure that out. With commercial real estate, it's about a formula. It's about cash flow calculations, debt service coverage. People may disagree on the formula, but we're all trying to use the same numbers to ascribe value to this asset. Bringing it back to due diligence. So what I like to do as an investor is just know how much of this is rinse and repeat versus new business initiative. Have you ever done hotel development before? Okay, that's all you've ever done? Great. Or is this your first time and you don't know what you're about to step on? Because it's not just the hotel, right? Who's the service provider? Who's the lender? Are they predictable? Who's the seller? Who's the, so that's what I would say. You listen to enough podcasts, you'll get a sense of that. And then there's nothing better than making your first passive investment because you'll take it super, super seriously. So I go down the education rabbit hole and then make a passive investment with the team you feel comfortable with.
Again, I want to keep this sort of like baby steps, like just for those that don't know. So, okay, so let's say I find a great fund and it's an operator and I understand their niche or I understand what they specialize in. They have a track record. I've done my homework. We always say, do not invest in something you don't understand. Even if you're not going to be the one who's changing out the toilets at the rental property, you need to understand what you're investing in. So I love that you brought that up first. So thank you for doing that. But at a certain point in that conversation or in that timeline, what happens to your money? Where does it go? When does it come back? Like, what is just magically you get a new check in 5 years, or like what can that look like as far as the return? Obviously not any sort of percentage guarantees, but as far as the structure of how you get your money back from something like this.
So the way it works is that there are 2 classes of shares in these types of investments. The GP, what's called the general partner ownership. Those are the operators. Those are the people overseeing the whole deal. And the LP, limited partner investors. And by the way, it's called LP because you're limited in the only risk you're incurring is your investment risk. So when you invest 50 grand, there's no scenario in which you lose more than 50 grand, meaning that somebody has a dog, they attack the thing, they die. It's like you don't have transparency, oversight. You're not buying insurance. You're not on the loan. You're limited to the investment amount. And because of that limitation, it really changes the entire risk profile of owning real estate, which you are, because you don't have that liability or credit risk. This is a really important point. But the operator is incurring that risk. They're going on the loan. They're doing all the work. And so to do that, they're compensated. And here's how they're compensated. Usually, the limited partner investor gets what's called a preferred return, usually between 6 and 8%, meaning that in any given year, the investor is owed 6 to 8%. And then anything above that is split usually something like 70-30, 70 going to the investor, 30 going to the operator.
Wow. That's a higher percentage pool than I would have expected for the sort of like overage over that minimum threshold.
That's the standard one for like buying existing deals, I would say. Now, just to clarify, usually it doesn't go over that 6% until the deal is sold. So it's like you may get like 4%, 5%, 6%, 7%. And all those years, anything under the 6%, let's say, is accruing. Then the deal is sold. And it's like there's this $10 million windfall. $3 million of it goes to the investor to pay off their original investment. Another $1 million goes to them to pay off their preferred return. You've got 6 left over. Of that 6, 70 goes to the investor, 70% goes to the investor, and 30% goes to the operator. And everyone has made millions of dollars. And over a 5-year period, you would see returns typically in the 14 to 18% range if you're buying like existing real estate. If you're developing real estate, you would expect it to be higher because you're incurring development risk. If you're buying hyper stabilized prime market real estate in Los Angeles, California, you expect the returns to be lower because the risks are so low. It's like you're just basically buying a, already performing 100% occupied deal. So that's kind of the spectrum of what's out there. And there's a bunch of other benefits, but the main one is that you can just go and see the property. That's it. You don't have to be a genius. You don't got to predict how many iPads Apple's going to sell next quarter, even though every hedge fund in America can't predict it as well. You just got to go and see, hey, is there 90, is it a 100 unit property? Are there 90 people here? It's about 90% occupied, probably going to be fine. That's it.
So let's say, I've done my research. I've read your book. I've listened to some podcasts. I've gained the vocabulary of getting into a deal into real estate as a limited partner. And so I reach out to this person and they say, hey, actually, this investment is reserved for accredited investors only. And we're sort of through our 38 available sort of non-accredited investors on this fund, but good luck to you. So if you run into a situation like that, can you explain like what's going on there if someone like wants to invest in something and they're not allowed to?
Yeah, and I'll be just myself as always, because that's why you guys paid me the big bucks to come on the show. So I'm just going to keep it a buck with you. So first of all, the term is non-accredited or accredited. And so what an accredited investor is someone who makes $200,000 a year and expects to continue to make that much money, or $300,000 a year with their spouse and it continues to expect that to make that much money, or someone who has $1 million net worth excluding their primary residence. And so that's like a normal definition of an accredited investor. And so most of the types of deals that we do at ASIM Capital are limited to accredited investors. And so your question is, what happens if someone listens to this podcast and goes out and deals with me and I say, sorry, we'll let you know if we change that policy, but right now it's only accredited. And so here's the big reality. If you make less than $200,000 a year, I don't think you should be investing in real estate. You should be dumping money into coaching, consulting, leveling up your skills to make more and more money. Because I don't want you, if you have $100,000 net worth, I don't want you to put $50,000 with me. That's insane.
Right. Yeah.
Yeah. And we tell people that really, because again, what we advocate is growth assets, meaning, again, if you're just working for a salary and you expect that to take you to wealth, or if you're just a service provider as a creative professional and you're just charging a rate for your hourly service, there's not a scalable solution to you building intergenerational or even just enough wealth to retire on. So what we then say is, your business is the place you should start.
Yes.
Start by growing the business you have. So if you're listening to this podcast, which our community is a lot of salon owners and tattoo shops and people who are creative professionals, that's what they're doing. They're growing their business. And I think you're exactly right. It's like, that's what you should be doing when you're starting and when you're building up that initial growth period of education and insight and experience and maybe a scalable business with employees and maybe a location. And then comes a point, as you said, when you can start to look at what we would say graduate to larger investments.
Yeah. And I'm not trying to do the Grant Cardone thing where he's like, well, you're broke if you don't make $500,000 a year. That's not what I'm saying. It's really not the message. But what I'm saying is, if you have a business that's generating cash, like the best way for you to make money is to go all in on that business, not to invest with me. And I can think of all the reasons that you should invest with me financially that would benefit me. But it's like, I actually want you to truly step your game up, open up a new salon, get more clients. By the way, get more employees. Those are real high leverage activities. Real estate is a tool for wealth preservation, not doubling every year. If you have a new employee, they should double their value every year. So by the way, I am a significant investor in our deals, but my money is not best spent investing passively in real estate. And by the way, passively, like I'm working my butt off, unlike the LP investors we have. I would much rather think about it like this from an investor's perspective. Who do you want underwriting these deals? Somebody I hire in Upwork for $22 an hour, or someone that makes $180,000 a year that lives in Phoenix, right?
Right.
Like that's where my $180,000 should go. And it's investors' best interest for them to go there as well.
We teach this this is like my philosophy on wealth building in a 3-step framework. Out of that framework, the first step is maximize your earned income. Like become excellent at one thing, because so many people try to go do a second thing while they're mediocre at the first thing. expecting that they'll be excellent at the second thing when really they're just twice as mediocre at those two things now. But we see all these things out there that it's like, okay, well, I'm not making money here. I should go start this side hustle rather than actually just doubling down on what's actually generating money for me in my career. And so like maximizing that earned income, like you said, is the first step before you start going into wealth multiplication, wealth preservation, and those phases. And I love what you said about that. And I know that you also have a philosophy I'd love for you to talk about.
So here's the thing. I know that look, it is difficult. Business is hard, and it's most difficult in the beginning, right? And so what people think, and this is why I tell the stories that I tell, which we haven't, gotten into all my trials and tribulations and failures, but I assure you, I have more than most people. That's why I've accomplished what I've accomplished. That's the way to accomplish things. And, I never really, who's the guy that's obsessed with not being in debt? What's our boy's name?
Dave Ramsey.
Dave Ramsey. So I'm never like listening to Dave. Okay. So I never have been obsessed with Dave Ramsey, but he had a quote recently that I saw on Instagram randomly that was like, damn, that is heavy hitting, which is that quote, when I look back on my career, I see this incredible mountain of shrapnel of all my mistakes and iterations, but I'm on top of it, not underneath it.
I do like that.
And it's like, that's the way. That is the way. And the problem is it's way easier to look at other people and go, easier for you because you blank. You know what I mean? And sometimes it gets so gnarly that it inverts. I know someone that was literally homeless that now owns $100 million worth of real estate. And I swear to God, I'm a competitive person. So when I hear him speak, dude, I go, dude, it's easy for you to say you were homeless. I'm like, what was that thought? Like, how did that just happen in my own head? Like, it's easier for you to get on the stage because your story's so great because you were homeless. He's like, yeah, bro, I was homeless. You think that was easy? Like, anyway, so we can't help ourselves as entrepreneurs and competitive people to check out and say it's easy for you, but that is where people get to go. Almost all of the people that are successful that you look up to, aka Tony Robbins, lived in his car. You know what I mean? Overwhelmingly, those are the stories of the people that you aspire to be. And so anyway, I lost my train of thought there, but it's just an incredibly important point. When you're in the heat of the battle, you think that whatever risk you're going through that is a career defining risk, which it's not, and a relationship defining risk, which it may be, depending on who your relationship is.
Let's dive in on this a little bit, because this is the thought that had popped in my mind is I think there are people who are interested in real estate. They're tracking with this whole conversation so far, but they say, yeah, but Hunter and Cash, because Cash, you're buying and selling real estate all the time. It's like, guys, all the real estate market's about to fall apart, and there's these high interest rates. And I keep seeing these articles in the front page of the Wall Street Journal or the New York Times or Yahoo News that are saying that we're about to have another great recession. And so now would be a bad time to buy, right? Because the values are really high. So, and I'm not even criticizing that perspective. I think that's a legitimate thing to notice and be concerned about as someone who wants to be wise with your money. So would you mind predicting the future for us, Hunter? No, but seriously, like, how do you look at the future with what's going on and still make a plan to succeed?
Fair enough. And it may be, right? So, and it depends, right? And that's not just a cop out. Like, I'm going to give you my honest opinion. So the Federal Reserve recently, and for the last year or so, has increased interest rates dramatically. The federal funds rate, which is like the foundation underpinning all financial assets, it's the lowest, bonds, for example, or the Fed, 10-year bonds are the lowest risk investment in the United States and likely the world. So they are the foundation on which all financial assets are traded to some degree, because it is the first point to move, and therefore everything higher in risk is dependent on that number. Right? So if you have a CD in a bank account, its underlying asset is essentially the federal funds rate. So when the Fed moves interest rates, every financial asset changes in value, if that makes sense, because it is the underpinning of the entire US dollar, basically. So the Fed moved the federal funds rate basically from 0.05 to 5.5, 111 times what it was from, the bottom of 2020 to now 2022. And so all financial assets, their value will struggle, all things being equal. And so if you have fixed rate debt, let's say you bought a home and you have a 30-year mortgage at 4%, the fact that interest rates rise or fall doesn't really matter to you. Your interest rate is the same and your payments will therefore be the same. However, not all real estate was purchased with fixed rate debt. In fact, in more competitive markets, some people took floating rate debt because floating rate debt, or also known as adjustable mortgages, are usually cheaper because the borrower is incurring the risk of the interest rate rising in this scenario. So you could borrow fixed rate debt at 5%, or you can get floating rate debt that is start at 3.5%, but it might be able to rise way above 5%, maybe to go 6 and 7%. Does that make sense so far?
100%.
Yeah.
Okay,
Absolutely.
great.
Yep.
So what ended up happening is in the more competitive markets with better fundamentals, AKA population growth, job growth, income growth, wage growth, people are moving there from all over the country. Fortune 500 companies are moving there. Those markets got so competitive that you can only make the deals pencil if you took floating rate debt. So now in real estate, we have a very interesting situation. The best markets in the country are distressed because the people are still there. The Fortune 500 companies are still there. All those fundamentals are still there. People are moving there. Everyone's moving from California to Florida and California to Phoenix and all these things. But the interest rates on these assets over the last couple of years, if you bought 2 years ago, your interest rate probably went from 3.5% to 7%. And it doesn't matter how many people move there. No one could recover from your interest rate doubling, your debt service doubling during.
It has a huge impact on your monthly payments.
Exactly.
Right? Yeah.
So now sellers are coming to terms with this and starting to let go assets at huge 25% plus discounts in the best markets in the country. And it's not like 2008 where everyone's unemployed. Unemployment is at like a multi-decade low. Job growth, those things are still there. It's simply financial distress. And so this is why we are not retreating. My partner, who just got married to a second generation Asian, who has spent their entire life in Michigan. And I mention that because if you have any Asian family members, you know these are very tight-knit communities. They left Michigan and moved to Phoenix to take advantage of this once, and I really do mean once a generation type of opportunity. Especially it's unique because it's just financial distress given interest rates. And so that's what we're doing.
I want to give Cash some credit here because Cash, a year ago, we had a student workshop. And Cash was talking about this a year ago, and it was exactly this issue, which is you have these shorter term interest, these shorter term loans. You have variable rate, floating rate loans, and that the opportunity to buy properties that are going to be at a discount is massive. And that's something we've been talking about for a minute.
That's why I went into fundraising. Yeah, because I felt like being in real estate and looking at the commercial space, there was a huge opportunity looming. And everything I do in my business is I want to be prepared for opportunity. I can't predict the future, right? I don't have a crystal ball. But I want to be prepared. And if I see indicators, I want to be prepared for what is likely to happen or possible to happen if it's going to be a huge opportunity. And I felt like there was going to be a once in a lifetime opportunity. And that's when I started getting into fundraising. And, what kind of led me down the path to meeting Hunter, because I felt like it was evident, it was obvious, because I'm looking at this stuff every single day. When you see the Fed raising interest rates, like you're explaining, at the speed, not just raising interest rates, they've done that, and they've raised them much higher in the past. Rates in the 80s reached to 18+%, right? So we're not even seeing record high rates right now. What we're seeing is record high prices due to inflation with higher rates and rates that were raised. So like rates being 18% when you could buy a property in New York for 70 grand. That's a different story, right? Rates being, 7-8% when property average home value is $450,000. That poses a much harder affordability question to the American public. And then on top of that, all these commercial properties and all these investors using floating rate debt to get into the market and not buying rate caps to protect themselves against these things. Now those things have become astronomically expensive. Hunter, can you talk a little bit about what some of the opportunities and things that are, you think are likely to happen in these pretty historically booming markets, but now that's changing?
Yeah. So, we are specialists in Phoenix, so I'll kind of focus on that, but I'll give you some broad data points to look at as well. Obviously in 2008, Phoenix struggled drastically because of the housing crisis and crash. But a lot of that was due to very unique loan products that came into existence and then disappeared. And what ended up happening is, Phoenix is a desert. There's a lot of room for development. little tiny micro cities that basically were just controlled by brand new development came into existence. But the only reason they came into existence is that people could apply and get loans that didn't have a social security number. So that came and it created this massive boom in the United States, but particularly in a couple markets, Vegas, Phoenix, et cetera. And then those loan products went away and were basically banned. And those little micro cities got destroyed and values went down drastically. But since then, Phoenix has changed immensely. You know, the governor and also the city planners have put in a lot of work to kind of retool the market of Phoenix and also just the growing, robust nature of Phoenix. There's some unique qualities of Phoenix. It's very good weather. It's close to California. California went crazy with the lockdown stuff. Hundreds of thousands of people moved from all over the country to come to Phoenix. And now the economy is extremely robust. And I think it's less than 20% of the economy is related to real estate or construction. And you have massive tech boom, infrastructure boom, government, you name it. It's the fifth largest city in America. So you can imagine now the economy is very robust. Wow. Yes, that's the case. There's a company right now building a $40 billion plant in Phoenix. They did more research than we have access to. There's another $20 billion plant being developed in Phoenix as well.
Is manufacturing? Like is this chip manufacturing?
There's a semiconductor development that's taking place.
If you're making a $20 billion plant, it's a microchip.
Yes. And they could have done it anywhere in the world, but they decided to do it's a Taiwan company. You can search it. It's one of the largest foreign investments of all time. People are just flooding there. That's what's going on. And yet still it's very affordable compared to the other prime markets, AKA New York, San Francisco, San Diego, et cetera, et cetera. So the market dynamics are interesting, but can I just be brutally honest with you? All of this stuff is just Googleable. This is nothing nuanced or even remotely proprietary. What really matters in this business, if you're a passive investor, especially a new passive investor, is to understand that this entire portion of the podcast is essentially irrelevant compared to who the principals are and what they're going to do when things go wrong. Because Phoenix is a booming market is about as valuable as they're not making any more land. So you should invest in real estate.
Buy low, sell high.
Exactly. 100%.
Yeah.
But I know I've been through enough in this industry to know what I'm made of. And it's not just about being a good person. We're very well capitalized. So when things go wrong, like they always do, we're there to take bullets for our investors, make it right, do the right thing. And of course, there's risk with every investment, but there's certain things that we do behind the scenes that we're good people. We owe it to our investors. We're well capitalized. And, my reputation is worth well more than just one or two deals. So, that's what happens. That's what really matters.
Especially given how public you are too. I think you've stuck your neck out in a way that I think puts a lot on you. But I love that you're bringing this up. This is a risky investment, like all investments. You have to be educated. You have to know what you're doing. Are there questions that you advise people ask general partners if they're having that conversation? If they feel like, yes, I'm in this stage, I want to have that conversation. Are there canary and coal mine questions or things you'd be looking at a little bit beneath the surface beyond just the sort of PowerPoint presentation that help people sort of make the right decision with who they want to do business with?
The questions that I would ask are, how much of this is rinse and repeat? I would also probably like to do some research from referrals, but not their investor friends, because it's just their best friends that they've known forever. But I want to talk to their CPA, maybe their contractor, their general contractor, and see, are they really doing these deals? Can I get third-party reports? If you think that this property is currently rented for $1,300 a month, and you think you can raise rents to $1,500 a month, can I get access to those third-party reports that suggest that? And by the way,
you're entitled to the answer to all those questions.
Yes.
You're suggesting?
I would, especially if you're getting started, I would try to do as much research without talking to the operator, because your time with that operator is going to be very limited if you're investing 50 grand. If it's 5 million, they're going to do a lot different, but you've got about 30 minutes to an hour to get the questions answered. But that doesn't mean you only need to research the topic for an hour. It just means with the sponsor or the general partner, as we mentioned earlier, probably have an hour. So, but here's the cool thing. When you ask these types of questions, you'll uncover that there's a spectrum of competency out there. So like when someone asks, hey, you're saying, number one, the fact that you're asking this is great. You're calling out the fact that we're trying to raise rents by $200. And I want to commend you for that. That's exactly right. And yes, I'll give you the third party reports, but I can do you one better. this actual property that we're buying, the units that have already been renovated, they're actually renovating and renting for $1,500 a month. So I can show you the third party report, but I actually can show you the property itself. There's 100 units, 20 of them are renovated, and the 20 that are renovated are renting for $1,500 a month. How big of a no-brainer is that? All we're going to do is renovate the remaining 80. That sounds like a compelling investment opportunity in terms of rinse and repeat. And when you talk to sponsors, you're going to see there's a spectrum. Some are going to say, the guy that sold me the deal thinks it can rent for $1,500. Not you. Somebody's going to say, well, I downloaded this thing from CoStar and it says $1,500 and we toured the assets and it looks pretty good. Hey, good start. Someone else is going to say the asset itself is already renting for $1,500. Damn, I really like that guy more. You know what I mean? Those are the kind of things that I'm looking for as a passive investor.
Yeah, the proof is in the pudding. Cash, I think that one of the things you wanted to touch on, and maybe Cash, maybe you can give your perspective on this, having been to one of Hunter's events. And then Hunter, for the remainder of our conversation, I'd love to just dive into this a little bit. It's like, aside from being successful in doing what you're doing in the real estate, and as someone who raises capital from limited partners, you've also built an incredibly successful brand and a community at raisingcapital.com and with the Raise Masters group that you've created, and people coming from all over the country to collaborate with you and to learn from you and to connect with you. Cash, what was it like going to an event like that? And I'm curious what you saw Hunter doing that was part of the reason I know that you wanted to have him with us.
Well, you could immediately tell that the level of organization behind the event, it was my first introduction to Hunter, was the event. I made it my point to meet as many people as I possibly could. As when I go to these events, I want to meet and connect with as many people as possible. The quality of the people that I was spending time with suggested a high ticket price to entry because of the quality of the people that were in the room at the event, the conversations we were having between, whether it was economics, investment, real estate, all these topics that are related to the event. But I was really impressed when I saw Hunter was building a business. And when I heard that the business, my friend had told me, hey, he's grown this business to something crazy. And then you said it from the stage. You took a business from an idea, from like nothing to an 8-figure business in 31 months, if that's correct. I believe 31 months. That's an insane accomplishment and feat. And so I want to talk about some of the things that you've done to produce those results in your business, because like you said, double down on your business. Like start like maximizing your income before you start doing these things. Learn how to be a great business person, like become excellent at what you do, make as much money as you can there. I want to talk about, what this journey was like for you doing this and some of the lessons you've learned along the way in building a business that quickly, because most crash and burn.
Yeah, man. That's true. So yeah, first of all, thanks for the kind words. And I'll just say, I had a lot earlier in my life suggesting that I was going to live a pretty mediocre life and have a mediocre amount of income. And I'm sure that there's a lot of people that are listening to this show feel the same. I know we were talking about your audience and who you cater to. And there's a lot of people I'm sure that didn't do very well in school. There's a lot of people that had to go to detention. There's a lot of people that maybe had challenging relationships with their parents because they were underperforming in certain things, especially academia. That's me. So it was always like going through school. I just remember, gosh, what would it be like to be a straight A student? Like, what would you even talk about? You come home and your parents are like, hey, how was your day? It's like, great. What's for dinner? Like that was very, you know what I mean? Like how much different would that been than the contentious challenges that a lot of us dealt with. But my friends, if you're listening to the show, I already know damn well that you found some things that you really liked that were outside of that world, and you figured out at some point that these rules didn't really apply to you. And then it was just a matter of how far you wanted to take it. So for me, the first thing I from an early age loved this concept of business. At first, it's just sales. Buy something for $5 and sell it for $6. You know what I mean? And like my first iteration of this was my mother lived near a popular concert venue. And so whenever there would be concerts, there'd be a problem with parking. And so I asked my mom, hey, can I rent out like our yard basically for $5 a piece and we'll split the profits? And I made my first $100 and was like, dude, I am
You're hooked.
Rich 5-year-old at this point. Like we're opening up a bank account. Like let's get crazy. And then it's just a numbers game. It's fun. It's competitive. The next iteration for me though, was running in cross country. And so I was gifted at cross country. I didn't get to go and run Division 1. There's probably some schools that I could have walked on. I wasn't recruited by Division 1, but I was recruited in Division 2 and Division 3. But irregardless of that, I was a star at my particular school. And so I was like, holy crap, if I dedicate time, energy, if I become not just someone who runs cross country, but dude, I was a runner. That is what I was, meaning that when I would look at anything with numbers, and this is no joke, by the way, if I saw a clock, I would think about where I would be on a 3-mile course. Like it was in my DNA that I was a runner. By the way, I got to say that one of the benefits of, and one of the common themes of most entrepreneurs that are successful is they always think they're like a little bit above the level that they actually are because they're trying to chase the horizon. So I literally remember I applied early decision to go to American University to run, by the way. I eventually didn't get a call from the coach. I'm like, they must have lost my number. I called the coach proactively, and was like, yo, I sent in my stuff. So like, what are we doing this summer? The quote was, he goes, what is your mile time? I told him, he goes, dude, he's like, we've got someone that's going to go, which I ran a 4:38 in high school. He goes, dude, we have someone who's going to go sub 4 this year. He goes, honestly, I've never said this before. You might get lapped in the mile. It's a 4-lap race. He goes, you're going to get lapped. Gosh. So, okay. So, but the point though, is that that was always my energy. It was not humbling. I was like, oh, he just doesn't know. Give me one more race. It was like, I was always one step away from figuring it all out. Why do you think I have a podcast? Why do you think I did those events? Because no one would have me on their podcast and no one would have me speak at their events. And I was like, if no one's going to figure out that I'm a gangster, I'll create my own.
I love it.
That's a quote.
You know? And so there we go.
At what point did you realize, okay, and this is so, and there's a similar journey here, Hunter, because, Millionaire Hairstylist is a community of creative professionals learning how to have the financial edge and pursuing financial success. And you have decided at a certain point in your journey as someone who invests in real estate that, you know what, I actually want to help teach other people to do what I'm doing. So talk to me about that moment when you decided, maybe I can also teach this and build a community around this. And just what that journey has been like.
Yeah. And thank you for bringing me back to the point there, because the reason I was trying to say that is that because of the fact of that's where my background is, I figured out that I can do this. Anyone can do this. Anyone who's dedicated and willing to outwork anyone being disciplined, anyone's willing to focus, anyone who's ready to hear no's over and over again and just not accept it and think it is just one race away from working out. Here's what ends up happening. You're right. And that's the beauty of business. Is that it doesn't matter what your genetics are. It doesn't matter if you're not really that talented at running. If you simply don't quit, you'll pretty much beat everyone. And so I decided to write a book about raising capital after I had raised tens of millions of dollars. The book did very well and took off, at least from my perspective. And though it wasn't written to be a New York Times bestseller, it did create some very high buy-in readers. As in, I kind of gave away the whole playbook. And so people wanted the next thing. And so I launched a company called raisingcapital.com, which is our e-learning mastermind business. And the offer under the raisingcapital.com banner is Raise Masters. And it's the #1 mastermind for elite capital raisers. And very much like my conversation with the coach at American, we launched the slogan #1 mastermind for elite capital raisers when we launched it. Right. But the reason was
shout out from the rooftops. There you go.
Exactly. But it was the only one. And so it was the #1. And so, and that's the way that I want to play the game. And so you can play the game the way that I am playing it as well. You can plant your flag in the ground and be, we're #1, baby, because it's just us. And so if you're listening to this right now, whatever that means, wherever you are in your life, anytime you can honestly make the claim that you've got no competitors, it will work for you. It will work for you for 2 reasons. #1, you'll have no competitors. #2, you will be known. So, because if any time raising money comes up, I'm going to be in that conversation because I planted my flag in the ground. By the way, sometimes entrepreneurs and business owners, they are unwilling to do what I'm suggesting because they don't want to give up on all the other business. But the problem is you aren't not known. You aren't known. That's everyone's problem, including my own. Meaning that if you're known, where that no one can go anywhere but see you, everything else is going to be irrelevant. But if you try to be a jack of all trades and there's no marketing behind you and there's no reason for someone to bring you up every time one thing comes up, they will never bring you up at all. And so you just got to get one thing right. And then that's the answer, by the way. The way we scaled Raise Masters to $10 million in revenue in 31 months is we're better than everyone at one thing. And it happens to be extremely lucrative. And we kept it very simple. We did one webinar every week live for a year and a half and generated around $8 million of revenue. It stopped working. We pivoted to a 15-minute video, and now we did another 2 million. It's simple, 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 because simplicity is the only thing that can scale, and scaling itself creates incredible complications. So rather than do what we were talking about before and spray and pray, just all you got to do is add 10 million to one business. And that's what we did.
That's very interesting.
Simple scales. I want to talk about that because it's really easy for people to feel overwhelmed in the throes of, your org chart, hiring, firing, training, retention, sales, marketing. You've got all these departments, and you kept things so simple in the beginning. I want you to talk and share a little bit about how you got the right people involved in your business, because right now there seems to be a pandemic in small businesses where everyone is struggling acquiring good talent. So can you tell me a little bit about, building a $10 million business is not easy, especially doing it as fast as you have, but who was with you along the way? Who did you bring along the way, and how did you choose those people?
So the first person I brought was really standard, like freshman level entrepreneurship, which is like, I like this person. He should be part of the company. Okay. And so I spoke on a podcast. It was a really out there libertarian podcast. And I talked about commercial real estate. And the person that was like right after me was like a flat earth person. So like I was like the most buttoned up, blue pilled person that any of these people had ever heard about. I got 0 phone calls, 0 emails. No one reached out to me except for one guy who was like, I'm in the libertarian world too, but I've never heard anyone talk about commercial real estate through that libertarian lens. Do you have like a course or something that I could learn about? And I created a course about how to invest in real estate and sold it to him. And he ended up being my first employee. And he's just one of those ride or die guys where one day I call him and say, we're launching the #1 mastermind for commercial real estate. And when you go back and listen to the sales calls, dude, it's insane. He would tell these people, we're the #1 mastermind for capital raisers. And they would go, who's in it? And he'd go, well, you can be, because there was no one. But that, you need that. You need a ride or die person when you're getting started that will just do anything and say anything to anybody because they're just ultra high buy-in. And I still have them, by the way, which is awesome. But as you grow, you start to attract higher caliber talent, experts in their niche, not jack of all trades, but talk about rinse and repeat. I think I can announce this now. We hired a COO who was Grant Cardone's former CFO. And maybe your audience don't know who that is, but that's like the top of the food chain when it comes to what I do.
Yeah.
But hey, you want a new opportunity? You think I'm a good leader? I'll bring you over. And now what is the likelihood that that person's going to add value to our business? Right. And that's every hire we've made at the director level or higher is just they've done exactly what I want to do. And they did it for the last 24 months. And now bring them over. Congratulations. You're no longer a manager. You're now a director, and you can, and just a rocket ship. And that's the way we've done it. One other thing we've done is put up a massive filter of who we want in our company. And I learned this the hard way. And Cash, I know you were there when I talked about this topic, but if you're an entrepreneur and you've had trouble hiring people who are, don't really have the kind of work ethic that you have, it's not because they're not entrepreneurs. That's actually totally a myth. What ends up happening is that you as the entrepreneur, you love your business, you better, and you sell them on your business and you expect them to come in and fall in line. We unsell our business. We say things like, look, we are not the work-life balance company. We're the get stuff done company. You know what I mean? Like there's many ways that we say, like, if you think this is, you get to work for a fun startup because you take all this vacation time. It's like, I don't know what, because think about it. I have 25 employees. That's only 25 people. Every person plays a critical role. I don't need to hire okay people. And so if someone comes on and they're not up to that level, it's 100% my fault because the filter wasn't deep enough. And then eventually you do this enough. If you end up having an interview or hiring someone who's not on that level, it sticks out like a sore thumb. So those are some of the lessons I learned with the hiring stuff.
Cash, I think you said the other night that when the harder it's been to find quality people, the higher you raise your standards in your companies.
Yeah, the filter has to get high. The filter has to become tighter and stronger and harder to get through. The harder it is to find the talent that you're looking for, because you're put yourself in a position. I think this is what I think in hiring, and I think when you're a really fast growing business, you need people, and so if you're in the position of need, you're very likely to get a bad deal and make a desperate choice. And I think that's why we want to always be recruiting, having that machine on at all times so that I have options. And those options that I like, the options that I take, I unsell them on the job. Like the last sales rep we hired, it was like, hey, I don't think this job may not be for you. This is really hard work. You're going to be answering phones on the weekend. This is not going to be your little check-in, check out at 5:30 p.m. This is for people who want to win, people who love to win, and people who are competitive. That's who we're hiring. I'm not sure it's for you. She called back and begged for the job. And it's interesting. And that's a real estate negotiation thing too. It's like you unsell them on the idea, and it makes people want the position more. And that's been a great filter for us in our business. But I think I want to be in the position where I have the options and I'm making the choice. And when I raise those standards, I just want to always have an abundant flow of opportunity so that my standards can be super high. And I'm not like desperate. I've got to fill that role. Just take anybody. That's when I've made my worst decisions. Hunter, you've probably, well, maybe I can't make the assumption, but you've probably had at least one bad hire. I hope to God. I'll feel terrible if you haven't.
Yeah. So I don't know if you were at that session, but I talked about the way I learned this lesson, as with any lessons, going back to the Dave, is it Dave Ramsey? That quote?
The quote of the pilot. Yeah,
that's right.
Yeah.
So we worked through a recruiter to hire an assistant for me, and a US based assistant, like a serious salary kind of person. And did all this research, 100 applications through a recruiter that was going to make 20 grand. The recruiter was going to make 20 grand. So this is a serious role. And she quit on the first day. And by the way, I was the only person she interacted with. And she told me not to take it personally. I'm like, literally, I'm the only person you talk to. So what am I supposed to say?
Wow.
But here's the thing. I was like, okay, wow, bad luck. Of course, like this person was weak, who cares? Let's move on. And we did the same thing. And then the next person they brought on quit on the 30th day. And that's when, and by the way, that was a very different personality, very different. She was not weak. She was a killer, but her response was very interesting. She was like, yo, I can easily get another job where I have to only work half the time and I can flip houses on the side. So I am a killer. I'm going to work, but I'm just not going to work for you like this. And I was like, oh, interesting. That's cool. So it's on me. Like I didn't understand the first person was like not cut out for the work environment. The second person was a total killer because that's what we hired for, but I misunderstood that she's kind of used to having a cushy job. This all comes from insecurity, by the way. Think about it. It took me this experience to understand that I was a killer. I talked about my high school. What do you think was my high school? I was a freaking slacker, C student. I literally remember in college, in microeconomics, which is a topic I'm interested in, I had to get a 76 to pass. On the final, I had to get a 76. So it's like, I'll come down to the final, right? It's 100 questions. You got to get 76 of them right. You know what I got on the test? 76. And you know what I did? I go, this is my genuine reaction. I am the smartest man alive because my goal was to do the littlest amount of work to get exactly what I wanted, which was the freaking C. And so it's like Tommy Boy. It's like, they're not just going around handing out D minuses. That was my attitude. So I figured I was a slacker. So when I go to hire, I'm thinking, this assistant used to work for a billionaire. Certainly she's going to be capable for working for me. It's like, no, turns out that billionaire doesn't know what Calendly is and understand that you can send a link to schedule a call. We're going to be working around here. You know what I mean? So,
amen.
But that's on me.
Hunter, I want to be respectful of your time and close things out. And I love the perspective you provided to our audience, letting them see a part of the world that I just don't think they're aware exists, particularly in the idea of syndication and funds with real estate. I hope people go out and do their homework and do the research and also listen to your podcast. Cash and I have both been listening and really enjoying that. And obviously Cash is part of Raise Masters, so the proof is in the pudding there. But thank you for spending time with us and sharing.
No problem. Do you mind if I tell people where to go to learn more?
Please do.
Yes.
So number one, if you want to tap into your network, but don't want to do the deals of real estate, I created a course called Fund of Funds. It's all going to be explained at a URL called fundoffundsmastery.com. You can raise capital from your existing network and invest in the type of deals that we do and rely on our expertise or anyone's expertise for that matter. Number two, if you want to learn about passive investing, just go to asymcapital.com. You can find my podcast there. And if you're an accredited investor, you can invest.
Amazing. Thank you so much.
I really enjoyed it, guys. Thanks a ton.
If you're a hairstylist, if you're a creative professional, and you are interested in your financial well-being, remember to like and subscribe so that more episodes just like this one show up in your YouTube feed.